Okay, here we go.
Are we live yet?
3, 2, 3, 2, 2, 1. And we are live, it says YouTube. How you going, mate?
Good, man. How are you?
Yeah, pretty good. Pretty good. Been a bit of a busy week, and we're recording on a Friday arvo. It's December 10th at 3 p.m. I'm not going to lie. I did have a beer over lunch. So my mental capacity, I'm probably not there today, but I'm excited to talk about some interesting companies. We've got a few US tech stocks getting sold down. We've had Alcidion here in Australia make an acquisition of Silverlink. And we've got Magellan, which is a fascinating story unfolding before our very eyes. But that's what we can talk about today. We're obviously going to take some questions. If you are tuning in for the live stream, you can just hit the live stream chat there and you can say g'day, ask us your questions about whatever topics you want. Say hello. It'd be wonderful to hear from you. So that's kind of the administration side of the live stream and the podcast this week. I feel like we haven't done these for a while. How long has it been? 2 weeks, 3 weeks?
It's been a couple of weeks, I think, couple at least, that we haven't done. I mean, okay, before I was going to ask you, you've been really busy, and therefore maybe you can tell us why you were busy, but I saw some beautiful photographs of you having good food at good locations, so that's always good. But before that, I was going to challenge your assumption. I mean, you're putting Aussies to shame if you say that you can't think after having one beer. That's just going to be like, this stream is broadcast live worldwide, right? I mean, I can't let that happen. With one beer, come on.
You're right. You're right.
You are on fire.
That's lubrication. That's lubrication for an Australian.
Exactly.
We are not even
on fire.
Tip of the iceberg. Yeah.
Tip of the iceberg.
Australians get better. If you ask anyone from overseas, we get better with 5 beers. So I'm still on that. I'm still ramping up into it. But it's the curse of the Friday afternoon, right? It's one of those things in the office, the corporate office. You cannot have a meeting on a Friday afternoon because who knows where the lunchtime takes you. But no, it's very actually, just come to think of it now, this is actually the first time that we've been out for lunch, or at least I've been out for lunch for well over a year, and you can just enjoy yourself, and it's busy here in Melbourne. So it's actually fantastic. It's fantastic to see people out and doing things, and it's really, a change from this time a year ago, this time 6 months ago. So I'm stoked with that. But hey, that's enough about me and my antics on a Friday midday. What about you? What have you been working on? It feels like it's been forever.
What have I been working on? Well, I've been writing year-end reviews. So basically for stocks that are on the seven investing scorecard that I either follow or I have recommended. Just writing a year-end review, sort of trying to just think through what happened to the business. And I find that process very interesting because, sometimes you can, even the company that you own and you understand very well, sometimes it's good to actually just reflect. And there's no better thing than writing to reflect. And just, it just makes it a little bit, you really think through the thesis as to, is that really what's happening? Especially for troubled stocks, right? I mean, stocks that are not doing well, businesses that are having difficulty executing. I think it's really a useful thing to do. It's not so much for the companies, I guess, that are executing. That's one thing that I've been doing, and I think I found that quite enjoyable. What else did I do? I've been brushing up my watch list. But every time I brush my watch list clean using the shiny apple cloth, the stocks go up. So then I put it away, and if I put it away, it goes down. So I don't know what to do. Maybe I should keep brushing them so the stocks keep going up. But yeah, I've been doing that, and I've been looking for ideas for next month. For the January recommendations. I've been thinking about what to recommend for January.
Do you get some time off over Christmas, or how does that work?
I get time off. I mean, most of the stuff that we do it's pretty much on a regular cadence, right? So, our recommendations will come out 1st of January, but, we'll have them locked in due course. And I'm not, so usually December is the time, because of school holidays, when I travel. Well, I used to travel. I should rephrase that. And haven't traveled in 2 years.
Yeah, no.
Anyway, and I don't have any plans of traveling yet, because most of my travels usually are I like traveling overseas. and going to different places and seeing different things, and being the school holidays gives you just longer time to do that. But given how the rules keep changing every so often, I'm sort of in a wait and watch mode to just understand how things are unfolding. Yeah, so no, I have no travel plans, and so I'm actually at home. I'll be doing gardening.
More time for research.
More time for cutting grass. The amount of rain has been incessant. It's so much that my ride-on mower now needs service. So.
Oh wow. Okay. Yeah. Well, I wish I did have a ride-on. My grass is probably not long enough for that, but nor do I have enough of it to do. But it's always good just to be able to have a Christmas at home and just enjoy the time with family anyway, and not feel like you're rushed around. I think that's really neat. So we've got plenty of content to get through today. We're going to talk about Magellan, Alcidian. We're going to talk about some US tech stocks. We've got some cybersecurity companies that I know you're keen to talk about. Just in terms of what I've been working on just at Rask, we actually went away on a retreat to Daylesford in Victoria, which was heaps of fun. I don't know if you've ever been there to Daylesford on the outskirts of Melbourne. It's like an hour out or an hour and a half out.
Never been there.
Yeah, it's like it's a country town, but it's got a lot of character. So it's a really nice spot to get away as a couple, or as in, even as a team. It was lovely. But one of the things that we're working on at Rask, which I think is relevant to this conversation, is we're working on our value investor program. So this is where we do our online course, which trains you to basically do your own valuations and what have you. That's been the focus for me and for the team recently. And basically it's a sprint into Christmas trying to get this done. And for those, there are a few hundred people that have taken the course, the value investor program that we already had. But just to put it in context, I feel like this next version of the program is probably twice as extensive. So in the first one, it was when I pick the companies that we do our case studies with in this online course, I tend to pick the companies that I have a lot of conviction in. So last time it was PayPal, Pushpay here in Australia, and Xero. And each of those companies, I don't know if they multi-bag. Like I don't think Pushpay did. It definitely, obviously, has performed pretty well. But this time we're going to take, instead of having 3 case studies, we're going to have 5 or 6, and from a different mix of industries, and we're incorporating interviews throughout the course. So that's a heap of fun. It's called the Value Investor Program. That'll be out hopefully in a few weeks, if not a couple of months. So you can enroll and you can see all the reviews there on the Rask Education site. But that's what I've been working on. It's been good to go back and do that sort of stuff. If you want to join in the conversation, you can say g'day on YouTube Live. Just one more call for questions there. And also you can find us on Twitter at 7A Mahanti and at Owen Rask on Twitter. We love to chat, and occasionally we do spaces. So that's a bit of fun too. I know the 7 Investing team will occasionally jump on and chat. And there was a live stream yesterday with Simon Erickson, which is a heap of fun. So reach out to us on Twitter. Okay, mate. First of all, first cab off the rank is, I guess, Magellan. I'm not sure how well you know the Magellan business. I think we've been over it a little bit, but do you know much about it?
Well, I know the Magellan business. I know Hamish, or know of him, but I haven't actually been following what the drama is. I'm really keen to hear what's going on.
Yeah. So obviously the big thing with any global fund manager is performance. So not just a global fund manager, any fund manager is performance. And Hamish, having started, I believe it was 2007, 2008, he started the fund. What he was principally focused on at the time was reducing the downside capture. So what we mean by that, that's financial jargon for every fund manager says, we're going to try and beat the market with less than market risk. And so the way that they do that, obviously you can measure performance as returns since inception versus the benchmark. And then on the other side, for the risk side of that, they measure it in volatility. So it might be like standard deviation. Another way you can measure it, and it's a way that many, I think, good fund managers over time do it, is they basically look at the maximum drawdown. Mm-hmm. So a drawdown, for those of you that are new to it, is basically from the top to the next, trough, how far is that down before it recovers again? Mm-hmm. And you and I will know from investing in individual stocks that typically the companies with the drawdowns are often the most exciting, and the companies that go onto multi-bag. But in funds management, if you have a fund manager that has, say, 30 stocks in their portfolio, to have a massive drawdown is often a sign that they may not have as well diversified portfolio as they say. And it also means that a financial advisor finds it hard to recommend them to clients because clients just see the returns and like, oh gosh, I've got to sell this thing out. So Hamish has done a superb job, probably one of the best in Australia, if not the best in Australia, at basically articulating the message that you can protect a portfolio if you construct it smart. You construct it in a thoughtful manner where the betas of those individual positions, so that's like the volatility versus the market, is low. You can hold a little bit of cash and you can deploy that cash when the market crashes. And therefore, so one thing that people don't know about, at least new investors don't necessarily understand about having a cash position, is actually a cash position reduces your volatility. So say, let's say you have 20% of your portfolio in cash. When you measure the volatility, obviously you've got 20% of a portfolio that's automatically not going to have any volatility because it's invested in cash. So by default, as a fund manager, you can look better than the market from that perspective. And so by having, say, 10 or 20% in cash, you're already kind of over that base, provided your 80% of stocks aren't just kind of like 100x sales multiples. And so Hamish has done a really good job of managing that cash while also managing the individual stocks to make sure that their positions aren't too correlated, whatever. So let's fast forward from, that was say 2007, 2008, GFC, fast forward to now. The business is over $100 billion, I believe, in FUM. And the reality is, as a fund manager gets bigger, performance can drag. So you and I would know if we had $1,000, we could be a lot more kind of flexible with that money, invest it quickly and find tactical opportunities. Whereas if you've got 100 billion, you're obviously dealing with a lot of money. And so you can't be as nimble and as flexible, and it just becomes generally harder. Like Warren Buffett says this too. And so as the business has got bigger, it's created more funds. There are now these active ETFs inside the vehicle that earn a lower fee load. So the active fund that Hamish made his name on is a slightly higher fee. That's still where the majority of money is invested. One thing that Magellan has done really well, and I might just switch screens here if I can bring this up here for those of you that are watching live. For those of you that are listening, I'll explain it to you. But you can see here, here's the ASX release for Magellan for November 2021. And you can see the split of investor dollars here. So there's $116 billion in total. $86 billion of that is in the global equities or global stocks part of the management of the fund. There's the infrastructure sleeve of the business, which is also very appealing, run by Gerald Stack. And then there's Australian equities, which includes the acquisition of ALC funds and so on and so forth. And so what we can see here is FUM is still going up, but the flows and how much money people are actively investing is the thing that's up for debate and quite contentious right now. So this kind of sets the groundwork. So it's a massive global fund manager based here in Australia. So what's gone wrong? Why is this the business being sold down? If we just jump quickly across into the ticker terminal here, we can see that this is comparing the enterprise value of Magellan Financial Group, so the company that Hamish is the chief investment officer of. You can see this relates the earnings, the enterprise value. So this is market cap plus net cash to the revenue, and you can see here that there's been some pretty jarring moments over the past couple of years. And what this basically reflects, in my opinion, is sentiment. When I look at enterprise value to revenues and I see big falls in this ratio, what it pretty much tells me is that investors are willing to pay less. And so we've seen the funds under management growth called into question. We've just had the CEO announce his resignation after so many years at the helm. We've got this underperformance issue that has been the subject of the AFR articles. But then there's obviously some personal things going on behind the scenes that, frankly, in my opinion, I don't think deserve to be written about in a national newspaper from a personal perspective. I think it may be relevant to some investors who are looking at the company and saying, oh, well, maybe the chief is distracted. But you can see from that chart there that it's pretty simple. Investors have questions. And so what's this done? This has driven up the kind of the yield of the company. The company still makes a substantial amount of free cash flow, which I think shouldn't go unnoticed. So we're in a position now where all of a sudden, statistically, Magellan looks very cheap. It's actually at one of the cheapest points, the shares, as it has ever been. And there are only 2 instances, I believe, in the history of, well, at least the ticker terminal is showing me, where it's been cheaper from an enterprise value to sales ratio perspective. So this is like a long-winded way to introduce the problem, but I don't know if you have any questions around that, or kind of like, I can keep riffing, but I should draw breath and let you speak for a second.
Just a couple of comments. I think one is, I mean, so I guess the main thing in my mind is between 2007, 8, and now, I think the biggest change that has happened is the introduction of ETFs, right? So what you couldn't do previously, and you needed a fund manager to do it for you, now you could do using an ETF, right? And an advisor could recommend, at least a financial advisor could recommend a bundle of ETFs to essentially deliver you what a fund manager could deliver you, and potentially do that at lower fees. So I think that's something that is probably a headwind for the entire fund management industry, right, as a whole. I mean, most active fund managers, therefore, now have ETFs for that reason. Like now, ARC is a good example, right? So ARC has ETFs where, and it's a very interesting model in the sense that, you know, once you have an ETF, you actually have all the trades that you're making on a daily basis show up, especially if you're an active fund manager. So that's, I think, one thing I think that is different between now and then. I mean, as a continuum, it's a slow change. The only other thing I'll say is that I think from then to now, the market has, you know, it's been a bull market really, right? So, and we've only started seeing some volatility now, so maybe that's has some effect. I would contend that on a global scale of things, this is the only thing that I disagree with you, or at least partially disagree with you, is that I don't think what is happening would have anything to do with the firm size. The firm size could be, it's just very difficult. Like if I think of an Australian fund manager who's got, like, there is nobody, there are very few people, I guess, or there's probably no one who has $100 billion of firm in Australia as a single like entity, right? That is a huge amount of firm to have. But that firm is, I think, not a deterrent to performance, because I mean, I was just checking the performance of big tech this morning. I mean, you know, Google is up 69% year to date, and Apple is up 30% year to date, and I don't know, Tesla is up 50% year to date. So I mean, if you're buying global companies and you're only managing $80-90 billion of funds, that's really that's like a penny in the big ocean, right? And so I can understand if there's a problem for small caps, but it's not really and Australian small caps. When I say, if you say Australian small caps, and you're thinking like, sub $500 million market cap companies, for those, I think the firm size really matters. So I'd say those would be my high level comments. I have nothing to say about, what's going on in terms of personal life and stuff. And that, I guess my last comment would be, with any fund management house, and we talked about this before, I guess. The issue might be that if you have one star manager or one star person, and then the entire, I guess, firm inflow is a function of that star, that is that's a tailwind when you have it, and it's a headwind when you don't, or when people think you don't, or whatever it is. And I think that might be the other thing. So those are the things I can, again, as a distant observer, those would be my comments. But I'll pass it back to you.
Yeah. Okay. So, and I tend to agree with you in some respects. There is headwinds for active funds management generally. Like we see that across the board. I think one of the things that goes in the favor of Magellan right now is that the principal investment side of the portfolio, those kind of those larger strategic stakes, that I guess the genesis of that dates back to quite a few years ago, when they decided we're going to transition the active fund, the global fund, from open-ended to closed-ended to try and capture some of that capital. We're going to invest in this thing called Barrenjoey, which is an investment bank. We've got GYG, Guzman Y Gomez in there. We've got FinClear. So they've kind of built out this stable of brands underneath using the company's free cash flow, which I always think is really interesting, because I think that's, if I was a fund manager at scale earning millions upon millions of dollars of free cash flow, that's exactly what I would be doing. I'd be putting my money into these permanent equity positions. I'd be trying to lock in investors in my funds, trying to transition them across. And I think they've done a pretty good job of that. You're right, though. They're the only fund in Australia that, at least at the top of my mind, that has so few strategies and are not passive that have $100 billion. I'm just looking at some of the companies here. We've got Alibaba. This is going back, I think it was the end of October, so things might have changed since then. We've got Alphabet or Google. We've got Facebook, Microsoft, Netflix, Pepsi, SAP, Starbucks, the list goes on. And these companies are large and liquid. So to your point, even if you have, say, $80 billion in global equities, you may be able to invest that in a way that the liquidity profile of the positions that you own doesn't restrict you too much. But what I would say is that, maybe I think there are certain funds and strategies that are conducive to certain environments. So when, like you say, you've got a bull market, what strategies are conducive to that? Well, typically growth-orientated funds will do better in that environment, whereas value funds will do better when maybe there's volatility in the market. And I guess the general thing is here, I was having a chat with the guys internally about this the other day, is that one of the things that I like to do when I think about sentiment is how much worse can it get? And I very much take your point about Hamish being the lead singer of the band. Like, he's obviously a fantastic investor and he's done tremendous things at Magellan. So I've got a heap of respect for what he does. I think they have done a good job of grooming some of the other PMs now. They've got Dom Giuliano as deputy CIO. We don't hear as much from him as Hamish, but still, commander in chief when he's not around. If we look at the Airlie funds management business, we've got John Sevier, we've got Emma Fisher. So some really good investors coming up there. And one final piece that I'll have to say on this is, within the Magellan business, you basically have the active ETFs, which are the low cost version. So we're seeing that kind of hybrid model. They're aware of that shift to ETFs. Then you've got, if you want the kind of richer full noise experience, you've got that with the active fund at a higher fee load. Obviously, how much worse can it get? We could see instos leave, which is a normal part of being a funds management business. But you don't want too many to leave. They've got a good mix of that too. The other thing is, obviously, if we just see net outflows, continued underperformance, there are many things that can happen, but I think the market doesn't like the uncertainty of not having a CEO, particularly when one departs after so long at a successful business. I think that's something that the team will need to be working on. So I guess for me personally, like, I'm just bringing it up here. I think I wasn't too interested in the business a few months ago, but if they can right the ship on performance, which is so important, I think, the 5 to 6% dividend yield plus franking credits alone makes it really interesting. And I think all of a sudden it's gone from growth to value play. I think the key is that performance. If they can get that global fund right, which they have a track record for, they've still got capacity in that infrastructure fund, in the ETF core series. So I to be honest, mate, I just find it really interesting at these levels. Platinum is probably the case study that's gone before it. And I challenged one of the guys in the team to figure out, has it been market beating even with a declining share price? Can it continue to, has it outperformed just on dividends alone? So Virtuoso on YouTube just said, the exposure to China and Alibaba in particular also has had a big impact on the near-term performance. That, along with holding cash due to a pessimistic view on the recovery post-vaccine, I think. And yeah, so we've kind of seen that cash drag coming out of a vicious bull market. So I think this is a pretty polarizing debate. If anyone in the chat wants to tell us what they think of Magellan, let us know. And if you think it's buy, hold, or sell, we'd love to know what you think, because there were some people on Twitter that basically said it's time to short Magellan. And I think you and I both share similar views on this. I think if you're going to short something, first of all, it's really risky. Second of all, you probably don't want to do it when it's already bouncing off the bottom, so to speak.
Yeah, I would not short. There's a difference between not going long on something versus going short. Like, I mean, you want to only short those businesses that are for sure going to, go bankrupt or something like that. Or this is not a business going to go bankrupt. Like in the next 10 years, there's no chance of it going bankrupt. So, yeah. So no, I would not. That would be almost like burning money.
Yeah.
And your hands in the process. So no, thank you.
Yes, and I agree. Yes, so and it's a bit of fun. I had a tongue-in-cheek comment back to that, which is so which one are we shorting? Because it's one of the things where people tend to short right at the moment when there's most pessimism, and shorting requires a catalyst. In my view, you have to understand your time frame. Unless there's a catalyst, you don't want to short sentiment. That's what I've realized over the years. You don't want to short sentiment. If anything, you want to short it when it's at the other end of the spectrum, but then you don't know if it's going to just keep going because of easy money and whatever. But really interesting company. If you know a bit about it, jump into the chat. We've got some articles over on Rask Media. I think it's interesting. I think now's the time to look at it. If I was going to look at it, I think we're going to have some uncertainty with Brett Can stepping back, but super impressive business. Ant Bly says, Magellan has an investment strategy, say 5+ years, has the potential to perform well when there is much more clarity with COVID, China, etc. Yeah, so that's interesting. That exposure to China is obviously a key theme here. So I think Platinum a few years ago really missed out on the trade towards US tech, and they were still heavy in China tech. This is going back quite a few years now, and they kind of missed out on that kind of stardom that went to Magellan for that very reason. So that positioning from Magellan is really important. At the end of the day, sorry, go on, mate.
Yeah, no. So I was just quickly going to add that, the thing with China is, so this is what I've realized over the years, or after going back and forth about China, is that if you want exposure to China, you don't necessarily need to invest in companies that exclusively perform business in China. That just increases your risk. If you want to have exposure to China, you just need to have global enterprises that actually have a segment called China, and they're likely to do well because, if China is growing, those businesses should grow. And if China is clamping down or whatever the issues are, well, that's going to affect both local players and global players equally. The local players actually don't have the other part of the business really to climb on, right? Or at least to rest on. So, that's part of the issue. The other issue is that everybody, like a large chunk of China investments has happened via ADRs and or listings abroad, right? And right now it seems to me some of the issues are more geopolitical in nature. They're about punishing investors and not, and it's a bit like, it's a bit self, in the soccer terminology, like scoring self goals. So maybe some self goals are being scored here by penalizing companies that are actually doing. The US is doing that too to some extent by going after its big tech. So sometimes governments across the world actually love to score self goals because it seems to solve some agenda or something like that. But anyways, yeah, I think there are many ways to invest in China.
Yeah, there is, and I agree with you. You can ask most lawyers that are investors that getting direct exposure to China from a technical perspective can also be a bit challenging too. So I agree with you there. Daniel says, this is on Magellan, they have a great rollout of products that will need around 3 years to gain momentum. I suspect the future flows in those being ALE, Future Pay, Core Series, and ESG will cover the majority of outflows in the near term, which is interesting. Some of those ETFs and what have you are still coming off a relatively low base compared to the global fund. So something to follow very closely. I know I will be. Paul says the company's meh, but their podcast is interesting. So they do have a couple, I believe. So really interesting. So wonderful discussion there in the group, and thanks for chiming in. I quite like it. I just think it's interesting for a watch list position at the very least. Lots of free cash flow. So next company is actually, is it going to an ASX listed company? Why don't we go to a US listed company, and in particular a basket of US companies, seeing that we're on the topic of US, mate. Obviously, we talked about this a couple of weeks ago, but companies like Zoom, a lot of these internet SaaS companies have been absolutely smoked. So I guess just on that, anything in particular catching your eye, anything there that you think this is really interesting, this basket, any sectors, themes, what have you?
Yeah, here's the thing, right? A lot of those companies are starting to look attractive. It depends on what your position is. So Zoom, for example, right? If you look at its free cash flow, it looks like a really attractive business. That doesn't mean that the stock price can't go down further. It can again fall by half and look even more attractive, right? That's one part of sort of investing in high growth, high beta stocks. Like I've just noticed that like one basket of companies that I look at is sort of the cybersecurity, new age cybersecurity companies like say Zscaler, CrowdStrike, Cloudflare, and Cloudflare is not strictly cybersecurity, but even a company like Okta, and they've all they're all probably down 20% plus, 30% plus from their all-time highs, or from their recent highs or 52-week highs, and you could make the case that are they more value now? Well, I guess on a relative basis, they're more value now, but then, are they value? They're probably not value, right? So, I mean, that's the, but are they ever going to be value? That is a bigger question to ask. And I don't know the answer for that because, I mean, so let's take Zscaler as an example. Zscaler's recent quarter, they delivered something like 63% growth, and 60% growth. I'm just trying to pull up the numbers. So this was fiscal 2022, and so fiscal 2022, the revenue went up to 230 million odd. So that, if you just analyze that, that's roughly 800 odd, 900 odd million that you're looking at for the year. The growing at 60%. They hit 1 billion in ARR, which roughly tells you that in a year from now, they should be at a 1 billion revenue run rate easily because they've got that revenue locked in sort of in annual recurring revenue. And a free cash flow for this business was roughly 36% of the revenue. So this is a cash machine, right? If you think about it. Now, of course, when you do the free cash flow for these businesses, they all have stock-based compensation and things like that. So of course, that is getting added back. It's still printing GAAP losses, but then those the extra stock that's just being released, the dilution that shows up on the market cap or on the EV calculations as well, right? So I mean, the bottom line point, my point is that these, you could think of these businesses many different ways. An enterprise software business is a business that basically sells software to enterprises, large companies. It could decide to not be growing as quickly as it is doing today, and it would generate a lot of cash just by keeping its existing customers, right? So, I mean, that's something to keep in mind. The other thing that the CEO said on the call, for example, is that they think that they can go from $1 billion annual recurring revenue to about 6 billion annual or 5 billion annual recurring revenue. Or actually they said 6 to 6 times of the current annual recurring revenue, just on the basis of their current product set and upsells. That is pretty huge, right? Because that basically says that given the customer base that they've got, they think that they have this much opportunity. That's just innovation that can drive their growth. They've been basically pushing ARPU up. And that's just, if you think about the opportunity then going forward, that is a lot of opportunity there. So, but still, however you want to look at it, this is not going to look like a value bet at any point in time because, before it gets to value, people are going to snap it up and it's going to look no longer value, right? So that's the problem that you have with, but the way I like to think of these companies is if you can continue growing like this for, not even at this rate, let's say at 40% for several years, going forward, then if it's generating 5 billion in ARR 5 years from now or 4 years from now, I mean, it should generate 5 billion in ARR in 4 years from now if you even assume some slowdown in the growth rate. If you just have a 40% free cash flow margin, that's a $2 billion free cash flow per year, right? That is pretty significant cash generation, right? And that business could easily be $100 billion business at that point. So you could get a healthy double, or maybe a little bit more than a double in about 4 years. So again, of course, the multiple could be lower, in which case you just have to hold longer. Then one of the things I think that's interesting to think about is for a growth business, that's the best part of the growth, buying growth, is businesses with long runways and opportunities for growth and that are free cash flow generative and that are sticky, which typically is like enterprise software type of business, right? Typically enterprise software business, this is why enterprise software is so good. And people have sort of started realizing this, is that you could pay up a little bit and you might underperform for a while, but you just need to hold longer and then you should be fine. As long as the world doesn't break apart. But if the world breaks apart, then nothing that you hold is going to work anyway. So it doesn't matter.
I agree.
So there is some value to holding, so in many ways, growth helps you cover up for some mistakes that you might make on a valuation front. Whereas if you buy a value stock where you're trying to figure out the value of, is it going to be 20% up, 30% up, are you within that range? Then, if you make a small mistake, it can actually be pretty hefty cost to pay because, you're going to potentially lose the market for that reason. So I would say that there are a number of companies. Again, I hold all of these. I made some small purchases for some. For example, I bought some Zscaler. It was already a large position, so I didn't buy a lot more. But I bought some thinking that this is a business that's really executing really well. It knows what it is doing, so I added some. I like to be active when the market is going down because that makes me feel like I'm in control. That's just my way of dealing with the volatility.
So you buy shares because not just because, but it helps you to deal with volatility because you feel like you're taking advantage of it?
It feels like it feels like I'm taking advantage of it. It feels like, instead of just watching a portfolio go down, which just looks like, you've got so much red on the screen to look at. It's just, okay, things are down. I can take some action. I don't need the money right now. I can afford to wait for 5 years. And I've always done it that way, to feel like that, it's very difficult when you invest in the market, you're not really in control, but this is a way of making you feel that you're in control because you're taking positive action in a downturn. So I feel good about it, just doing that. And I do that to some positions again, I thought this was an attractive business to buy. So I bought, another one. I think CrowdStrike had again a good result and it could be an attractive buy at this point. As well. I didn't add to it. I just, because I follow Zscaler much more closely than I follow CrowdStrike. So my tendency then is to basically focus on those businesses that are doing well. I'll highlight another business, for some people to think about. I think this is an interesting one. So there's normally you would not think of, actually I'll point out one business first before there are two stock ideas here for people to look at.
Oh, here we go.
So there's a business called EPAM Systems. This is an IT services business, right? This stock has compounded at about 40% over the past decade.
EPAM, is it EPAM?
EPAM Systems. It has compounded at 40% over the last decade, right? So sometimes you'd find superb growth opportunities in areas that are rare. I shouldn't say rare. I mean, in areas that you wouldn't think are, hyper growth possibilities, right? But EPAM system is one of them. So again, it recently got added to S&P 500, and when things get added to the S&P bump was active, the S&P 500 bump, it got another 10% bump. But this has been again a very interesting business where it's just the graph is up and to the right. Exponential founder-run business. It's a phenomenal one. If again, if you look at the PE ratio, I think it looks expensive, but again, I've held the stock for a long time. Done really well on this one. So my intent of pointing this out is that sometimes there are industries that you do not think are like great ones to have, because there's so much competition in IT services and things like that. But there are winners, big winners in those areas too. So sometimes it helps to actually look outside sort of the obvious baskets, right? So people think of, you want to get the big winner, I have to buy that biotech, like that's going to solve cancer or something like that. It doesn't have to be like that, right? It can be something completely, boring, like IT services, as an example.
Yeah.
And I'll stop.
No, that's totally fair, and I agree. It's the picks and shovels play, right? I'm just going to bring this up here, which is what I brought up just when you were talking before. It's got Okta, Zscaler, and CrowdStrike in it, and you can see here that none of the. And I'm using ratios today because I'm lazy, and I just wanted to illustrate the point here that you said that they weren't cheap. They might never be cheap like value stocks, and you can see all of them here are above 20 times the sales on an EV enterprise value to revenues basis. But you also brought up the other point that they're growing fast. So if we bring in the revenues for the next 12 months, you can see, if I bring that back, you can see that each of the businesses have continued to report higher and higher and higher revenue every quarter. So these are businesses that are growing, even though maybe the sentiment, again, just using the ratios, there hasn't been there. We can see that the revenues are ratcheting up rapidly. And we see that with Okta, which is the business I'm most familiar of the three. With the Ortho acquisition, it's basically just dominating. I mean, there's Microsoft alongside it there too. Don't get me wrong, there are competitors, but it's dominating that kind of single sign-on and workforce management space. So a really interesting business. Yeah, okay. And then EPAM is a totally new business to me. If I think of IT consulting, I think of the big ones, which are more strategic and,
the Accentures of the world, right?
The Accentures of the world,
yeah,
that's what I think of.
But I mean, Accenture is like what, $100 or $200 billion company, right? So that's what, there's always the possibility of someone like EPAM becoming that $200 billion company, $100 billion company in the future, right? And I mean, sometimes they do IPO early, and then you can buy in early. And enjoy the ride, and maybe they are not going to become the Accenture, and that's always the possibility. But I like to say that you need to be consistent in your style, and if you think that you're going to be a multi-bagger investor, then you have to have many such attempts, and then you're going to get some of them right. And if you get some of them right, it should be enough. Those are the other I guess the point. I mean, Okta had good results. And the other thing I'll say is that many of these businesses, depends on the type of business, but a business like Okta, what you want to look at is just the remaining performance obligations, because companies really sign long-term deals with these guys. And when you look at a business that says, well, I've got $2 billion of remaining performance obligations, that's basically future revenue that's effectively locked in, that they're going to make over the course of time. And they would also tell you what is current, how much of that they're going to actually recognize over the next year. And you could see then from their guidance that, well, maybe 90% of their guidance is effectively the current RPO. Which means that if they can add just a little bit more, they're going to get more growth than what they're actually potentially projecting, right? So, I mean, it's just very predictable type of business, this enterprise software, which is why a lot of people like them.
And so the RPO, remaining performance obligations, basically tells you what's left to bill of a company, and then the current RPO means what they expect to bill in the next 12 months. So as you see that going up, you're basically getting, for a super reliable business like Okta, they're telling you, here's where the next 12 months, this is what we're going to have. And then the 12 months after that, and then 12, it's like a rolling next 12 months forecast. So it's super easy for you to get a handle on where they're going in the short term, which, as you say, investors love the predictability of these types of businesses. And that's why the Accentures, the SAPs, and the ERPs businesses of the world can just keep generating high margins even throughout market turbulence. Actually, speaking of which, just had a question here from Virtuoso. It says, Doc, are you planning to consolidate your portfolio into stable, larger names with the potential of a bear market when the burr stops? Or are you just going to stay and put and play the long game? I don't know the burr. I don't know what that BRRR means, but
so no. As I said, I mean, I'm a firm believer on sort of looking for multi-baggers. Like the best way to think about this is, I'll just give you. I've not put this out there. Maybe I should. I'll put it out on the Rask podcast platform first. But just to give you a bit of how multi-bagging really works for you. So as I said sometime back, I sold like what, 40% of my Tesla position because it was too large, right? But here's the magic of multi-bagging, right? The magic of multi-bagging is the amount of cash that I got back from selling my 40% of the stake is equivalent of 2x of the total capital I have ever put in my brokerage accounts, ever.
Wow.
Right.
So the 40% is twice the amount you've ever put into your
brokerage account. In my brokerage account, right? So that's just that is what happens when you can A, invest for the long term, and B, have conviction, and C, really follow your conviction, right? If you invest for the long term, look for multi-baggers, and you are, so I don't intend to change that. And the other thing that I think is important to realize is that I tend to invest in smaller businesses which have the potential to become the blue chip tomorrow. Right. So Tesla was not big tech until it became big tech. Right. So today it is big tech. It's bigger than Facebook. Right. And I know there are going to be people who are going to call it overvalued and whatnot, and they can continue calling this because they have been calling it overvalued. But the thing is that that's what you want to do. You want to own, or another example is Apple, right? I mean, this is again a stat I looked up this morning. So as I said, Apple is up 30%. That's, I mean, year to date, it's up 30%. Last 3 years, it's up 300% or something like that, right? So sometimes you can also, just by the very fact, if you own the best and if you own them with conviction and you just understand them really well, then you can opportunistically also use the big drawdowns or the downdrafts that you see along the way, right? And it happens to every company. It has happened to a company like Apple multiple number of times, right? I mean, 2018, it was like, falling like a stone. It's like Apple was dead. Here's the best cash flow machine in the world that's dead, right? So I think I don't intend to change that. I'm not doing anything different really. I let my positions become bigger. The companies become bigger over time, and they become more stable. Like one of the things I've realized recently in the turmoil is the two stocks that hold my portfolio in good position are Apple and Tesla. So, and they're both mega cap, and one of them wasn't a mega cap long time back. And when I started investing in Apple, like back in 2011, it wasn't a $1 trillion company at that time. So I think that's the thing. My lesson for me is just basically just invest in good companies and just ride the volatility, right? And
yeah, I just love that, mate, because and Virtuoso said money printing. Emma Fisher also, this is the Emma Fisher user on YouTube, could be the real Emma Fisher from Early Funds Management. Also made a comment there, so thanks for chiming in. But Virtuoso says money printing, and I think from that, I think you and I are very similar in this regard. The only way to achieve what you achieved with that, to say that I sold 40% of my holding, which was more than the money that I put into my brokerage account, the first rule is to make sure that you hold the company for that long, right? You cannot achieve that type of return if you're investing and your average holding period is less than, say, 2 years. It's just not going to happen, flat out. You might get lucky. You might be one in a million that somehow stumble across I don't know. I don't even know what kind of company would do that. And so I often get really frustrated when I see professional investors do this. I think to myself, you are such a good investor. Whether you're a stock picker, whether you run a newsletter or whatever it is, I think you're such a good investor. You found a great company. Why on earth are you selling it because you're a prediction for the next few months? Or why are you selling it because your valuation is 20%? It just blows my mind that these enormous value creators, these companies, people go and sell them. And I just think it's just too much for me. I just can't bring myself to do it. So I just keep holding it, even if it means a bit of pain in the short term. I just think the only way to get that is to hold on. And it comes back to that quote from Morgan Housel, which is 99% of long-term investing is doing nothing. The other 1% changes your life. You've got to hold it for a long period of time to get those types of returns. So Virtuoso just chimed in. I meant BRR as in it means money printing, and thanks for the answer. So that makes a lot of sense now. Thanks for clarifying. So there was one more company which I'd love to get to, which is a company called Alcidion. And for those of you that don't know Alcidion, we're going to switch gears massively. We're going to go back from sixth if we're talking about Tesla and Apple, and we're going to go back to first, even for Australian standards. It is a pretty small company. So trades on the ASX under the ticker code ALC, Alcidion Group. It's basically like a med tech company. So the way I think of Alcidion is basically a business that sells its software into hospitals and helps the hospitals manage patients. If you think about, we've all seen those Grey's Anatomies or Insert Hospital, Chicago Med Show, whatever you're into, where, back in the day, they would walk to the end of the patient's bed, they would grab the kind of little, I don't even know what you call it, little bit of paper, and they'd mark down what the patient is up to, what their vitals are. They'd record the time of the day, so on and so forth. And then you'd walk out into the nurse's admin area and you would see the whiteboard with all the names. Those days should be long behind hospitals, but the reality is they're not. And so the first wave of Alcidion was to modernize that approach, to have patient tracking, to bring kind of diagnostics and clinical decision-making systems into hospitals. Now, obviously, this is a business that sells software, so we like the things about it, in terms of sticky revenue. It's deeply embedded, it's recurring, all that sort of stuff. But the reality is that it's hard to sell into hospitals. So getting a hospital to take whatever sort of patient management software it's got, or clinical decision-making software it's got, taking that out and replacing it with Alcidion is hard, particularly when hospitals don't just want the best in patient tracking. They also want, clinical reporting. They also want what's going on with medicine and the pharmacy. It has to integrate there. It has to integrate with procurement, admin, all of this stuff. Emergency has to be able to use it if, the ICU is using it as well. And so they want integrated systems. And so typically what happens in these big hospitals is, and I'll switch over to screen sharing for those of you that are watching the video or joining live. So if we switch over here, we can see what typically happens inside a hospital. Alcidion would come in and it would offer, all of its platform would effectively talk to other parts of the hospital. So you'd have analytics. The doctors would be able to see vitals if the ambulance was coming into the ER, like what's the first touch point for the patient. And then we've got real-time interoperability here from the Maya Precision platform. So that's what it's called. It's called Maya Precision, and it's basically been not necessarily Maya, but the whole suite of Alcidion has been formed through acquisitions and also internal R&D. And you can see that here. So why is this interesting now? Why is Alcidion all of a sudden a company that we're talking about? Well, because it's just made the acquisition of a company called Silverlink. And what tends to happen in most hospitals, and this is a business that operates in the UK, Australia, and New Zealand, by the way, what tends to happen is there are big competitors like Epic in there, which Epic is a separate company altogether. And they basically come in and they basically offer this thing called an EPR, which is a platform or a system for managing everything in the hospital. So you can see on the left-hand side here, this is probably the highlight of the charts from the acquisition update. That basically shows where Alcidion plays and what hospitals need to run their systems. And for years, Alcidion has been stuck in this part of the chart up here. If you can see my mouse moving around, so like the clinical decision making. And now with this acquisition of Silverlink, they can go closer to becoming a true EPR. The thing is, this is a $55 million acquisition for Alcidion, which is massive considering it was only just over $300 million in market cap. So they're doing a capital raise and institutional placement. But basically, it makes both of these businesses more competitive. Silverlink signs typically longer term agreements. The one point to note is that, and this comes from the Rask analyst, Catherine Go, who wrote this up for our members, is that Silverlink hasn't won a contract in 5 years, from what we can tell. So the company is kind of stuttering in its growth, and this is where Alcidion, with a, kind of ambitious plan to transform hospitals, has come in and can kind of take it on and offer Silverlink software and integrated systems into its own and package that up for hospitals, and it can become more compelling. Because sometimes Alcidion has to run over the top of Epic or Cerner or one of these other EPR type businesses. So it's a really interesting partnership. I think the thing that I was a little bit disappointed in is if we can come up with the purchase price. The purchase price of $55 million, basically, I think it was off the top of my head around about 7 or 8 times sales for a business that isn't growing. So I think this maybe harkens back to what we were talking about before, which is that when you have such a sticky business, it can have a very stable valuation, even if that business is not growing. In this case, it really hasn't been growing, which means that I just thought that maybe the skew between earnouts could have been a bit more compelling for Alcidion shareholders, insofar as not a lot of it was left for the vendors of Silverlink to grow. I like to see more of an even split between cash upfront and some type of earnout for the business, particularly when it's such a big deal. So that's a bit disappointing, but on the whole, Kate Quirk, who runs Alcidion, has done a fantastic job along with her board to grow in the UK. So I think this adds to that value prop. I don't know, I've ranted for about 5 minutes there, but all in all, I like the deal. I think the strategic fit is there. It's just the valuation of Silverlink was probably the question mark, but all in all, I think it's a pretty good deal. And I can't remember if I own shares, but if I do, I'll be taking part. I just think It's like a pro rata non-renounceable rights issue, which means that you can get shares if you already own shares in the proportion set out here. So it's a 10 for 1, or 1 for 10, sorry, meaning that if for every 10.5 you currently own, you can get 1 new share at the price. So for some people that won't be very meaningful, but hey, it's below market. So interesting. Anyway, I've riffed for long enough. Any questions on that, mate?
I know I don't know this business that well, and yeah, I have nothing to say. The price doesn't look that bad. I mean, it's a stable 8 times. They could have paid maybe 6 times or 5 times or something, but maybe that's what they needed to pay to get the deal through.
Yeah, and that's the thing. You know, there probably aren't too many businesses that Alcidian could swallow that offer that strategic technology for the business in terms of adding to becoming a more fully fledged EPR. So, you know, in terms of what's available, they probably had to pay for it in terms of they had to pay that extra bit of froth on the top, but that's okay.
I guess quickly, the only other thing, I guess this is maybe in the riskier side. I'll suggest one thing that just came to my mind. So electronic patient record businesses, EPR businesses, like, I mean, if somebody has an EPR system already in place, that's very, very different. EPRs tend to be extremely sticky. So if somebody's got an EPR from Epic, that just impacts so much of the workflow that's extremely, really difficult to actually rip it off and offer something else, because it just has so many touch points. But I mean, you know, sometimes what happens is EPRs, you know, there's like there's probably like a 10-year review, at which point maybe you can get in and replace. So it's going to be a slow burn, but maybe they only just need a few wins, right? I mean, if you win one or two hospitals, that's probably going to move the dial for them by a lot. So
Alcidian is winning deals. I think they've got 2 of the trusts in the UK, which is you know, they're meaningful. Of the 150, I think one of the trusts was in that 30 to 40 range in terms of the size of the hospital. But when we looked at the size of hospitals, or trusts, we were looking at the number of employees. That's basically how we were judging the size of these potential deals. And the one thing to keep in mind is that if you can offer the fully fledged EPR, you tend to write deals in the tens of millions of pounds. Whereas if you're only offering, say, like a patient tracking solution, it might be in the 1 to 2 million pounds if you're lucky, right? So having this ability not only transforms, you know, the conversation around what we can offer, but it also transforms the deal sizes, how much they participate in those new rollouts when they come around. It's just like you said, if it's only every 10 years that one of these, you know, when these things go up for tender, they want to be able to have the full conversation, not just a tiny part of it, and not just piggyback on something else. And it's important to, according to Alcidion, it's important to break down the industry of trusts. So some of them only want best in breed and they're looking for a modular approach. Some of them have already tied up with an EPR and they don't want to have Cerner for 90% of it and then have Alcidion off to the side. And then some of them are happy to do like a more of a hybrid approach and be packaged them together. And so basically it just transforms that conversation. It gives them additional trust to sell into, to cross-sell and all that. And I think if you take a long-term perspective to this business, I think the shares, you know, again, look quite expensive, but it's a sticky, high margin, or at least will be high margin business that's growing year over year, run by aligned and talented board and management. So for Australian businesses and for Australian investors with a 10-year or 5-year horizon, I think this is a really interesting business, and it's one that we recommended quite a while ago, but one that I would still have a small slice of my portfolio in today. Admittedly, it is a small cap, so you've got to be aware to the risks. Doesn't offer a dividend or anything like that, so don't expect that anytime soon. But yeah, it's a really interesting business. That's ALC on the ASX. So just to recap what we've talked about today, we've talked about Magellan, which is a really interesting business. I would probably have it on my watch list, and you know, for dividend yield and for a few other reasons, if they can stabilize that global fund. We talked about the cybersecurity stocks, or you did in particular, and you talked about Zscaler, about Okta, about CrowdStrike, and these businesses are still growing rapidly, even though their share prices may have been a bit soft of late. And finally, Alcidion in there, which is a business that is on the ASX under ticker code ALC, growing, has made an acquisition, another really impressive business run by aligned people. I think the one thing that I'm going to take away from today, mate, and I did not know, is that how like meaningful that decision to sell Tesla was for you. I think that's such an and it's just amazing insight for investors that sit back and they think, is this long-term high growth investing worth it? Just even one or two of these over a lifetime can be really meaningful, right?
Oh, it can. Yeah. So investing really, so what I like to tell people is that investing seems like it's not working initially. The first 2 years seems like, well, nothing's happening. First 3 years seem like, then after 5 years, you start noticing that something is happening. And then the 10th year, you start like, oh, okay, this stuff really works, right? And then, from 10 to 15, 15 to 20, if you can really continue doing this, it really has a meaningful impact on not just yourself, your family, but also not just your time, right? You can choose to, if you invest well, you can actually be a master of your own time in many ways. And then the final thing I like to say about investing in businesses that are growing and interesting, you learn about the world, you learn about so many different things, and yeah. So yeah, it can, time is really there's, we can't go and create time quickly, right? Time is time. You just have to let it flow. And as you said, the quote you made about, sometimes you just have to, do your research, sit on your bum and sometimes do nothing. And then that's really, overactivity really does not get you anywhere.
Yeah. And that's what I've found is actually you can be, if all of the investors are as smart as each other, the one that does the best is the one that does the least, I found. So,
that's right.
Yeah, I think that's...
So just going to quickly comment on something else that, I know we are over time. So, one of the things that we hear about, that manager, reduced the position, this, that, and things like that. This is no advice, but this is just, just contrast that. A fund manager has to produce a report at the end of the month, commenting on what their position sizes are, which was biggest, which ones moved, which ones didn't, how much was the return. Well, if you're only reporting, to your partner at house, maybe they don't even ask you that question at the end of the month. You're not reporting to anyone. So as long as you're honest with your process, sometimes you just don't need to do anything, right? So a lot of the things that happen, moving things around, that overactivity, is probably not necessary. I know people who, as investors, probably if they were managing their own money, would probably not do anything. But if they're managing money for somebody else, they're just forced to do it because that's how the industry works, right? So,
yeah, and I agree. And I think a lot of us, when we look at professional fund managers, we probably pay too much attention to what they're buying or selling and not really understanding the incentives behind those moves. Some of them say valuation when really it's got nothing to do with that. Some of them say, this one, they come up with a thesis for selling it versus buying it, even intra-month. And really some of that can, if I'm being cynical, can just be window dressing. Remembering that most fund managers have to be fully invested at any one time. So we're paying them to be fully invested, which means that whether we like it or not, they can't just go to cash like you can, or they can't just ride out the volatility. That's what we're paying them to do, something in particular. So yeah, they're great. They're great for insights, not to knock on them, but it's different for personal investors.
You don't just don't pay too much attention to people's individual fund managers' moves, positions up and down and things like that. And, there's a ripple effect that can happen. The other thing that you said, which I have a contrarian view on this, so it's nice to have a fund or a, investment vehicle that is less volatile. But volatile is the price that you pay for excess returns. So if you can't talk, you're not going to get excess returns. You're going to get, and maybe that's okay for some, somebody wants 15% returns. That's going to be great. But if you want 30% returns, you can't get 30% returns per year. I'm not saying that you should, but I'm just as an example, you can't get that by minimizing volatility. And there are many ways, in cash as a hedge, you could buy puts or hedges. And trust me, I've tried everything. I have tried all the magic. And then ultimately I've come back to realize that, this stuff, it's just too hard. It was a lot of waste of time. You can't really pick, 9 out of 10 times you're not going to, it's like calling the recession. You're going to call out 25 recessions and then you're going to be right twice. So, so I've given up. Anyways.
Yep. I agree. So if people want to find out where they can go to subscribe and get this end of year review, I find these to be some of the best things that I read. The end of year review that you're doing for Seven Investing, where can they go to get that, mate?
Just go to 7investing.com/subscribe, use the Rask code, get some discount. And yeah, that's really it.
Yeah, cool.
Otherwise, follow us on Twitter.
Yeah, follow us on Twitter. We'll have the links in the show notes. If you're going to start US investing in 2022 here from Australia, you may as well get a 7 investing subscription because it's so cheap for the value that they create and these advisors are creating, like Anirban here. So just go and get one. You could even trial it for a month or two and see if you like it, and I think you will. So great stuff. And just to confirm, you're wearing a 7 investing t-shirt. Do you or does Simon make these available to the general and public?
Well, I think there is a shop actually. There is a shop.
There is a shop.
There is a shop. Although I will say this, the shop is not, I think on Shopify, a stock I own. I'm just a bit disappointed that if you're shopping from Australia, you're going to be, you're going to be slugged some really heavy shipping fees. So yeah.
Interesting. Maybe you need to get on Redbubble. Just saying Redbubble.
Maybe Redbubble is probably potentially better in terms of distribution. So yeah, I was a little taken aback by the shop's shipping fees, but yeah,
that's right. It looks like it's worth it. So there's some merch that we can get. Okay, and if you want to hear more from me, you can find me on Twitter at Owen Rask or head to www.rask.com.au. I'll let you know on Twitter when the Value Investor Program 2.0 is ready, or even when the beta is up and running. If you want to get in early and get in cheap, mate, it's always a pleasure. Thanks for taking the time to join me today.
Thank you.